This is an analysis from Alpha Business Media.
Today, we are breaking down a monumental shift happening in the global financial system. We're talking about a move away from the US dollar that is already having huge consequences for markets and really for nations all across the globe. $2 trillion. Just let that number sink in. That's the estimated amount of US government debt sold off in just a matter of weeks. An event like that sends a powerful shockwave through the entire global financial system. Now, this wasn't some random market panic. Not at all. This was a calculated, structural shift. So the big questions are, what actually caused this massive sell-off? What are the immediate effects we're seeing? And maybe most importantly, what does this all mean for the future of the global economy? Let's get into it. All right, let's dive right into the mechanics of this. The entire event, this whole $2 trillion shockwave, was triggered by one very specific development: a new currency settlement pilot program launched by the expanded BRICS Plus economic bloc. So here's the timeline. For 50 years, the entire global financial order was pretty much built on one thing: the petrodollar system. Then, on January 1st, 2026, the BRICS Plus nations, which now include energy superpowers like Saudi Arabia and the UAE, they flipped the switch on a system to trade oil without using the US dollar. And the result? Just a few weeks later, a truly historic sell-off of US government bonds kicked off. To really wrap your head around just how big of a shock this is, we first have to understand the 50-year-old system it just completely shattered.
The petrodollar system, it was a masterstroke of economic strategy. At its core, it was a simple agreement. Oil, the world's most vital commodity, would be bought and sold exclusively in US dollars. This simple rule created a permanent, almost artificial global demand for the currency. If you needed to buy oil, you absolutely needed dollars first.
And here's the really brilliant part: how this system just kept reinforcing itself. Oil-producing countries were flooded with dollars. So what did they do with all that cash? They recycled it by buying safe, liquid US Treasury bonds. This, in turn, helped fund America's deficits, while at the same time cementing the dollar's role as the world's #1 reserve asset. It was a perfect loop. But the key here, the thing that changes everything, is that the BRICS bridge pilot breaks this loop. See, when a country like Saudi Arabia sells oil to China and they settle that trade in, say, digital yuan, there's no need to hold massive dollar reserves anymore. All of a sudden, the main reason for these nations to keep buying US debt, it just evaporates. So what happens when the biggest buyers of US debt suddenly turn into sellers? Well, it has a direct, almost mechanical impact on the cost of money for literally everyone, everywhere. It really all comes down to a fundamental law of finance: the inverse relationship between bond prices and their yields. Think about it. As central banks start selling trillions in US Treasuries, that flood of supply pushes the price of those bonds down. To compensate and attract new buyers for these now cheaper bonds, the effective interest rate they pay out, what we call the yield, has to go up. And that is exactly what we saw happen. The yield on the US 10-year Treasury, which is the global benchmark for the risk-free rate of return, it spiked, and it spiked dramatically. Now, why does that matter to you? Because pretty much every other loan and investment in the world is priced off at this rate. That means the base cost of everything, from a mortgage to a car loan to a company's plan to expand, it all just got significantly more expensive. This surge also created something called a deeply inverted yield curve. Now, that's just a fancy way of saying short-term bonds are now paying out more than long-term ones. It's a crystal clear signal that investors are feeling really pessimistic about the economy in the near term. In fact, an inverted yield curve like this has come before every single major US recession for the last 50 years. Okay, so we've looked at the big macro picture. But how does a bond market crisis on Wall Street actually translate to the real economy on the other side of the world? To really understand that, we're going to use Nepal as a case study. For a country like Nepal, the fallout from this is not abstract at all. It hits them in 3 immediate and pretty severe ways. It threatens the stability of its $10 billion lifeline from remittances, it jacks up the cost of building essential infrastructure, and it forces its central bank into a very, very difficult geopolitical corner. As you can see, a huge part of Nepal's economy is powered by money sent home from its citizens working abroad. A global economic slowdown, which is often triggered by this kind of financial volatility, means fewer jobs and less income for those workers in the Middle East, the US, and Europe. And that directly threatens the flow of money that supports millions of families back home.
The impact on the country's development is just as direct. That 2% spike in the US Treasury yield, that translates to a 2% spike in the base financing cost for a massive, multi-billion-dollar project like the Budi Gandaki Dam. That kind of increase can be the difference between a project being viable and being completely unbankable, stalling national progress for years.
So, let's zoom back out. This whole crisis is forcing every single nation to confront a new reality. The unipolar, dollar-dominated world is, for all intents and purposes, over. The path forward is really uncertain, and the strategic choices that nations have to make are pretty stark. There are essentially two paths that can emerge from this. On one hand, you could have a managed fragmentation, where the shift away from the dollar happens gradually, giving countries time to adapt. On the other, you have a much more dangerous scenario, a geoeconomic conflict, where competing financial blocs start weaponizing currency and trade, forcing smaller nations into a brutal choice of who to align with. For countries caught in the middle of all this, just sitting on the sidelines is no longer an option. The stability they once took for granted was, in hindsight, a temporary privilege of a unipolar world. The belief that any nation can just remain a passive observer in this new environment, well, that's a dangerous delusion. So, the crucial point we're all left with is this. As the financial map of the world is being redrawn, the system of global alignment that has defined the last half-century is being redrawn right along with it. The ultimate question isn't just about currency anymore, it's about allegiance.